Hey, it's your tax BFF back with your free 5-minute breakdown finances, okay? And we're getting into the basics. Let's break down some tax brackets. What do you even know about it? Tune in and don't forget to like, comment, and subscribe. So today we're going to be talking about tax brackets. And I said we're going to take it back to the basics because we have talked about deductions. We've talked about S-Corp election. We're always talking about how to reduce your tax liability for our high earners and our small business owners. But a lot of you don't even realize that what we're deducting or why that even matters, or how your earnings and revenue actually play a role in your taxes. So we're gonna go to the basics. Tax brackets. So for 2023, the IRS has already increased some of the thresholds of income, the alternative minimum tax, as well as the earned income credit to go along with inflation, just like everybody else, right? We'll talk about increasing your prices on your small business later, but they've increased it. And this is important to you because number one, single filers making under $11,000. I'm pretty much probably not talking to you today, but I want to let you know maybe for your dependents, you don't have to file taxes. Okay, that is increased by a couple $100 this year, and it is something that you need to know. Now, married couples, they have actually increased that status up to for 35%, because I'm talking to my high earners and I'm talking to the people that are really getting hit by taxes. 35% for married couples is up to $462,500. Now, what that means, guys, a lot of people have heard married filing separately is the worst filing status. It takes away so many credits. And yes and no. Yes, you're not able to get like the earned income credit. Again, my high earners, we're not getting the earned income credit. You aren't able to write off student loan interest that you've paid, or get a deduction for your education credits, or daycare, dependent care credits. A lot of those credits are taken away for married filing separately. However, if your income is above the next tax bracket, then you may want to consider separating you two, to both of you take the 12% tax bracket instead of going to 22, and seeing with your deductions with either your business and your spouse's medical bills, or your medical bills and your spouse's startup costs. Whatever the case may be, your real estate assets are held to a certain threshold, meaning that you're making over 100 grand, you're probably not going to see that big of a deduction in your real estate loss. You can deduct up to the amount that you actually received, but we're not talking that major hit on that tax return unless we're talking to people that are within the thresholds. Now, you're sitting there, you're either thinking, I know I'm way below, or you're like, oh my goodness, where do I land? Don't let anyone tell you that the filing status that you're in is the worst one and you shouldn't be going into that filing status unless they are talking specifically about your income level and your income together versus separate. One major thing that you need to know about tax brackets is that they are on your earnings, right? So pass-through money is included in that gross income. Your passive income from maybe some real estate properties, that is included. Your stocks and dividends, all of that is included in your income and will bump you up. So when I'm talking to my small business owners and I'm talking about S-Corp election and things like that, I'm always talking about reducing your tax liability and not paying that self-employment tax on top of it. So we're always talking to small business owners and we're telling them, we need to reduce the amount of earnings taxes that you're paying. That's Social Security and Medicare taxes on LLCs. We want to reduce that. We want to eliminate that, which is why we take that S-Corp election. However, you are still going to take the pros from your S Corp and put them onto your individual tax return. Meaning that yes, you'll only pay earnings taxes on the amount of money that you paid yourself, but you also will be including that profit from the business on your personal return. Now, of course, you will have some savings with earnings taxes, but it can definitely take you to that next tax bracket. Let's take a look at the tax brackets just so you kind of have an understanding of where you are and so you know what to do when you're planning and tax planning and getting ready to pay taxes. Number one, 10%, I'm not talking to you guys, okay? 12% is the majority of small business owners typically have their earnings somewhere around 12%. Everything else might take them to the next level, but 12% is anything between $11,000 and $44,725 for single filers, all the way up to $89,450 for married, and head of household right in the middle at $59,850. 22% single filers is up to $95,375. Did you hear when I said $100,000 takes you over? It takes you all the way to a 24% tax bracket for single filers. 22% for married individuals is $190,000. So if you're both making $100,000, you know we're looking at married filing separately, right? Okay. And then head of household, $95,350. Then you go 24, 32, 35, and then 37% is 578,000 and above. Of course, I'm talking to the top 1%, and I am hoping that you're not getting a 5-minute financial fix. But most of us will be somewhere between 22 and 32. 32 caps off around 231,000 for single, 462 for married. Take a look at your income today. Figure out where exactly you fall, how much taxes you're going to pay. Do you need to be paying estimated taxes? Is married filing jointly or separately the best way for you? And what deductions or contributions do you need to make so that you're not giving the IRS all of your money? Thank you again for another episode with me on this Financial Friday. Click the link. Go binge my videos, comment, subscribe, stick with me. We're going places, saving money and growing businesses.